3, 2, 1. Welcome
All right.
to the show.
It is Friday. Market's closed today.
Yes.
Fantastic. It's almost like a day off for us.
It is. It's like a holla. It's like a reward.
It is like a little reward. Although the market may not be trading, but the market rolls on, right?
Yeah.
PCE numbers came out this morning. Inflation continues to move higher, basically in line with expectations, but inflation's not going down. And so very unlikely at this point, I think, that the Fed lowers rates in June. But we get a little slide that actually talks about that for a second. But a lot of stuff to go over. So TSP Weekly Podcast, 31 March 2024. So I got three things we're going to kind of combine together here that are absolute media head scratchers. And then we'll take a look at monthly candles because fortunately Thursday was the close of the month for March. So we'll take a look at the monthly candles, see what the long-term trend is. Bonus chart is gold. Take a look at the C Fund Weekly, and then I got a little mini rant at the end. Okay, head scratchers. So S&P 500 closes at a fresh all-time high on Friday or Thursday. Awesome, right? Strongest first quarter since 2019, right? Huge. So market's doing great. At the same time, the Fed comes out and says, or not the Fed, this author, don't sweat the prospect of no Fed rate cuts. And this was before the PCE numbers came out today. So don't sweat the prospect of no Fed rate cuts, economists say. Markets will still march higher. Markets have been marching higher since November of last year on this expectation that the Fed is going to lower rates. And now, presumably, if the Fed doesn't lower rates, you would think the market would start to decline. But apparently, we don't have to worry about that. Don't sweat that because the market's going to keep going higher.
Says that guy.
Says this guy. So just the main points of it, right? Markets will continue to rally even if the Fed chooses not to cut rates this year, says this guy. Traders are currently pricing in 55% chance that the Fed does cut rates in June, but it was 70% last week, and it's going to go down from 55% because, like I said, this was before the PCE numbers came out today. The equity investor's job is to pick out what's doing better, where the value is. This is insane. But as an economist stepping back, you say no. There's no reason for the equity market to go down. I don't even really, to be honest, pay attention to the Fed anymore because it obviously has nothing to do with what's going on in the market.
I don't think you're alone in that, right? So
yeah.
We kind of joked about this probably 3 or 4 Fed announcements ago.
Yeah.
Where people aren't responding the way that they used to.
Right.
So then is the market not taking into account what the Fed's doing?
Yeah.
It's kind of obvious that it's not.
Right.
Which is very abnormal.
Yeah. I mean, the one of the best memes is don't fight the Fed, right? And don't fight the tape, right? Those two, and a lot of times people forget about the second half of that, but don't fight the Fed and don't fight the tape. So
what do you mean by the tape is like the ticker, right?
Yeah.
That's the old days when it used to come out.
Used to come out on tape, yeah.
Jerry's that old.
I'm not that old. My dad was that. I have seen the tape before, but yeah. It means don't fight price. If price is going up, price is going up. That's the bottom line. And we talk about that all the time. But don't fight the Fed basically means when the Fed is raising rates, it's a wicked headwind for stocks. But since November, it hasn't been. Fed hasn't been raising rates since then. When it did start raising rates back in 2021, the market started rolling over in 22, which was what we would expect. But then since November, it's ripped higher. Anyway, so we're at all-time highs. The market's going to continue to rally. People are making a ton of money, right? And now juxtapose that with this one, okay? CNBC, still from CNBC, right? There's the link. the income a family of 4 needs to live comfortably, and we'll show what comfortably is, in 20 major U.S. cities. Okay. Family of 4 needs to make $275,000 to live comfortably in some of the most expensive U.S. cities. Okay, some of the most expensive cities. Comfortable is defined as income that you need to do this 50-30-20 budget. Okay, so it's a pretty common financial planning tool. 50% of your budget goes to housing and necessities, right? 30% is discretionary, and 20% goes to savings. So that's what everybody's goal should be in terms of financial planning, right? If you're a retail financial planning, if you go into a retail financial planner, that's what they want you to do. So to live comfortably within that 50-30-20 ratio of how you allocate your income, and your 2 adults and 2 kids. Okay, so it's not saying it's a 2-income family. Could be 1 income, but you have to make X amount to be able to do this 50-30-20. Okay, so Smart Asset extrapolated the income needed for that 50-30-20 budget based on cost of necessities using data from MIT Living Wage Calculator. Okay, so from some genius at MIT came up with this living wage calculator. So here's the list: $340,000 a year in San Francisco.
Like that doesn't surprise me, right? Because it's always off the chart for San Francisco, right?
And this is the median.
I know, yeah. We talked. So before we came on the show, Jerry was rattling this off to me, and I'm like, what? Like this? That is the middle, right? So half the people
are making more than that,
and half the people are making less. This is the median, right? And so, okay, places like San Francisco, San Jose, and Boston, I tend to write those off because those are like extreme examples.
They are, but we have plenty of federal employees.
But we live in Washington, D.C.
Yeah,
right?
or Arlington is probably. I mean, Arlington is right below Boston.
Yeah, Arlington, Virginia.
It's unbelievable.
300,000. But you get down to Washington, D.C., I don't know. These numbers don't make any sense to me because I'm like, you have to make that much to be able to live.
To do the 50-30-20.
Right. So what that means is 50% of your income goes to needs, right? Housing and utilities and
food,
things like that. 30% of your income goes towards wants, right? Vacations, discretionary, and 20% is savings. Now, what we know based off our several years of working with people with their retirement accounts is 20% isn't even a reality for most people. They're not putting it back 20%. Hopefully everybody that's watching us, you are, because you care about your retirement. But because that's the only way it's going to grow is if you put money aside for savings, right? So 20% is supposed to be for savings.
Right. Now if you're in TSP, if you put 5% in, the government's matching you. So now you're at 10% right there.
Yeah, you get 100% return. Right?
Yeah.
We always tell people, like, you want 100% return on your money? Put in, if you're in the TSP or if you're in any company, if you work for a company that matches, 5%, give them 5%, they give you 5%, you just made 100% on your money.
Right. So you made 100% on that piece, but now you're up to 10% of the 20% that you need to contribute, right? So if you max out as a government employee, if you max out TSP, you're including the matching, you're up to that 20%, right? So it's relatively easy, not to say that it's easy to max out TSP, because depending on the other 50% here and the 30% there, you may not be able to do the 20% over here, right?
Yeah. That's the most common, argument that we get is like, man, I can barely make it through the month, much less maximize my my retirement account, not just the TSP, like anyone. Right. And we live in a we live in the richest county in America, Loudoun County, Virginia, right? Fairfax County, I think, is second. Like, I haven't checked it in a couple of years, but they're pretty high up there. Yeah. And the fact that, but all the, it's richest county, it's not like wealth.
Right.
That's different.
It's
right?
disposable income.
Right. Yeah. But hardly any of the folks that we talk to are putting back 20%. So just the 50-30-20 thing is like hard enough to hit,
if not impossible.
Yeah,
and based on as a government employee,
based on this, this list, like I would be interested, like all those that watch this that are watching this, put in the comment section where you're watching this. Tell us what your take on that is.
Yep.
Like, maybe we're out of the loop because we're retired guys. We still work, obviously, but we're out of the gov. We're out. Like, does that even seem like reality? Because I don't know. I mean, this is based on research. So
I mean, it's a new article, right? So I know if you read the article, they incorporate the cost of housing in these places. And so since housing has gone up so much, they're not saying that people actually in DC that can do the 50, 30, 20 make $275,000 a year. They're saying that based on the cost of housing, that's what it would take.
Right. And again, some of these cities, like, I kind of get it, right? But not all of them.
What government military person that's assigned to the Pentagon or any of the gazillions of agencies in DC
is making $275,000? Yeah. Maybe some of the admirals and generals, but not the captains and majors.
Yeah, no.
And definitely not the enlisted folks.
No.
Holy mackerel.
Yeah.
I'm not sure what to take away from that article at all. Like, well, you got us spun off here.
Yeah. So, okay. So those are the biggest 20, right? Of the 99 cities that they actually looked at, Family of Four would need a median of the 99 cities. The median of that was 226, right? Unbelievable. Houston, it dropped to 175. So that's the lowest of all the cities examined. So of the 99 cities they looked at, Houston was the least expensive place that you could do the 50, 30, 20 ratio, and you need $175,000 a year. I mean, and of course, the median income in the U.S. is $92,700. And I thought that was high. But
yeah, and this is that last sentence down there is kind of it's interesting. Again, we're skewed because we live here, and so we're in one of those places where the housing costs are ridiculous. And but you read that last sentence: to make ends meet, families might skip out on home ownership.
Yeah.
Owning a vehicle or discretionary purchases. The rest of it I got, but the home ownership thing is, like, for instance, where we live, it's almost more expensive to rent.
Yes.
Like, it's really weird around here, right? Where if you got a mortgage on that townhouse, which is, we're inundated with
$800,000 townhouse.
Don't even get me started on the $800,000 condo.
Yeah.
Much less a big townhouse. But anyway, I don't like. It's not necessarily cheaper to rent though here.
No.
And again, I really hope we can get some comments from you guys in the comment section about what your world looks like, because we're assuming that you are a federal employee or or military member because you're watching this, right? And so, what does your world look like where you're at?
I mean, where we're at, right?
We're skewed because we've been here for 30 years.
Well,
or 20.
So the DC area is pretty interesting, especially out in Virginia. So when they say Arlington and a little bit west of that, it's interesting because it's the hub of the internet, right? And there's so much tech and people making
ridiculous money.
I mean, stupid money.
Yeah,
right?
yeah. We know people that make $250,000 and they basically have a desk job at an IT company.
Yeah,
right?
which is actually their living or their bedroom, and because they're not going into work, right?
Right, they're not even going to work anymore. Yeah,
unbelievable.
But not what your average. So we have a big split between high tech, and then high government.
Yeah.
And and then there's contractors that go back and forth between the two. Yeah. And so that's the world we live in here. I don't, I lived in Arkansas for like 8 or 10 years, and that world was drastically different than this world. And so, if you live anywhere else in the country, it'd be interesting to see like what these numbers like is. I can't even imagine, living in. I could imagine living in Texas and having to make $175,000
in Houston
to meet the 50. Because all we're saying is, like this article is saying, is you need to make that much money to be able to live within the 50, 30, 20
Right. That's
rule.
what quote unquote comfortable means.
Yeah, that's what comfortable is be able to live with those. And I we don't do financial planning, but we talk to a lot of them, and we do research on this stuff. And what I found is mostly that the 20% is just like off the charts, meaning most people don't meet that 20%. Right. And then it's more like 50-50 almost, like 50%, stuff I have to pay, and 50%.
Well, if you think of the 50% that's non-discretionary, right? It's housing, utilities, food.
Right.
Housing around here is, let's say, $4,000 a month, right? Yeah. That's probably relatively average to low, right? $4,000 a month.
That might be the median.
And that's after tax.
Yeah.
Right? It's out of your pocket, $4,000 a month. Food is not cheap here, obviously. Car payments, like all that, that's pretty much the same everywhere. But that's your 50%. So that means, let's just say housing is $4,000 a month. And that's probably, of the 50%, that's probably, say, 75% of that 50% is housing, right? And 25% is going to be utilities, food, and that stuff, right? If 75% of the 50% is $4,000, you got to be making $12,000 a month to do any of this, right? After taxes.
Yeah. That is Why did you put in that article? We're taking up all this time.
I know. Let's keep on going. It was a head scratcher. That's what I said. Right?
Yeah, exactly.
3 minutes. So the market is at new all-time highs. The Fed says don't worry about it. They're not. Well, the author said don't worry about the Fed not cutting rates this year because the market's going to keep on ripping. And people, I would argue, based on this last article, can't afford to live in the United States.
Right. Yeah, that's the takeaway.
Government employees.
That's it. Yeah, if you have to make that much money to live comfortably, which means you're meeting the 50-30-20 rule, that's a lot. That's a lot. You shouldn't have to make that much money.
I don't even want to go down the road of the next thoughts that are in my head. But my feeds and all my social media is all about like where you can live in other countries.
Well, that's mostly because we're always searching for that.
I know, but you to do the 50-30-20 in like Costa Rica or
that's
Portugal
a whole different
or
world.
Yeah,
right. We're constantly looking for where we're actually going to retire because this isn't real retirement. But about 10 years from now, you guys won't see this show anymore. At least we won't be on it, probably.
Well, probably not. We'll have somebody doing it, but it might not be us. And if it is from us, it's not going to be from the most expensive county in the United States. Virginia. Okay, I have to scramble my brain to go on to the next part. Monthly candles. So monthly candles are really good. I'm going to try to do this once a month because we only get monthly candles once a month, right? So a candle, if we take like this red candle right there, okay, what that means is price opened at the top of the candle, top of the rectangle, closed. So at the beginning of the month, it was at the top of the rectangle. It closed at the bottom of the rectangle, okay, and in between was all the price action that happened during that month. That's what happens on a red candle. On a green candle, it's the opposite. Price opens at the bottom of the candle and closes at the top. And all the price action during the month happened within it, okay? So the monthly candles are good because it tells us like the long-term direction of the trend. And so when you put in long-term trend lines and they get broken, something is definitely happening. If you're really looking for my absolute line in the sand, the monthly candles are giving it to you, okay? We broke out here in 1995, was the beginning of the tech rally, okay? We had this recession in 94. Once we broke out of that channel, the market just ripped higher for a long time, okay? We get a little pullback, and then we had enough data to draw a trend line. So obviously this part was outside of this channel, right? If you had drawn this channel, this part of it is outside of it. That's fine. And you took some pretty, percentage basis wise, some pretty big losses here to get back down to that trend line. But once you broke that trend line to the downside, this big red candle right there, that was telling you that this long-term trend that had been in place for 2, 4, 5 years was over, right? Same thing here, going into the top in 2007. We didn't have the same kind of a look like we had going into the top of the tech rally. This was much more corrective, right? But once we had enough support levels to draw a trend line, and we had that move up higher, just like over here, this channel got broken right there to the upside, which is great. Everybody wants that. But once it came back down, hit that trend line, it came back and retested it right there, and then straight down. So the monthly candles are really, really important, okay? So where we are now, we've been in this channel. So all I did was draw a trend line right? So COVID is an outlier. We'll talk about that in a second. But all I did was draw the trend line to all these support points and then clone this line, right? So it's the same angle, clone that and brought it up to the majority of the tops up here, okay? So that's the channel that we're basically in on a long-term monthly basis. COVID was an overshoot. So it's not, it makes sense that you would have an overshoot to the upside, okay, to maintain the median of the trend. And then it picks back up, comes back down into the channel, gets support at the lower channel line again. So we should expect some resistance up here at the upper channel line, okay? So we should expect the market goes a little higher, comes back down, hits that channel line, and keeps on going, right? That's what history would tell us is going to happen going forward. This eventual decline, that's 4,300 right there. People will be freaking out about this move, but it's almost definitely going to happen. So as you're looking at it on a long-term monthly basis, you're like, okay, we're getting close to that upper channel line. I should expect resistance there. And when I get there, that might be a time to take some chips off the table in anticipation of the next likely move. Okay. So that's the long-term kind of look and why monthly candles are really, really valuable. If we look at it on the S fund, forget about this. I can't seem to get rid of it. It's in TradingView. I think it's some kind of aberration, but I'm not sure. But we're in the same kind of channel. Not as clean as the C fund, but you can draw the obvious bottoms, and the trend line becomes really obvious. And all I did again was clone it and bring it up to the what made sense on an upper channel basis. If this was an overshoot for COVID, and this was an overshoot to the upside with the stimulus after COVID. So if this is the channel, you still got some room to run to the upside on the S fund before we hit significant resistance, right? Okay. I fund. The bottoms are great. The bottoms are really clear. Again, the overshoot in COVID. When you bring the line up, it's not as good, right? It's not as this high didn't get to the line, this high didn't get to the line, so it's not as great a trend line on the upside. So to say that we have all this room to move up, you should expect to hit resistance, some kind of resistance level up here. But that gives you basically an idea of the channel for the I fund. It could absolutely continue up to the top of that channel. F fund is a little bit different story. Okay, we talked about this before, but this is the beginning of the F fund back in 2003. Okay, if you were in the F fund since its inception in 2003, you are way underwater still, right? This decline in bonds was the biggest decline in like 300 years. And the question of whether or not we're going to get out of it anytime soon is still really up in the air. Because if you look at the channel, I mean, it's definitely going down. You can argue that this little piece, is going up, but the big picture of the channel is still going down. So that's the big view of it. If we zoom in a little bit, again, this is a monthly candles, right? So we had this low in 2018, and the F fund just ripped higher for 2 years. And if you drew that trend line, you absolutely could have avoided this decline in bonds, right? If you just drew that trend line, it broke the trend line right there, came back up and retested it, and then it was over. So the trend lines don't guarantee that, once they fail, there's no guarantee that the market's going to roll over there, but it's a giant red flag. And on a monthly candle, it's much more significant, put it that way. Okay, so bonds, I mean, as of right now, this could be the beginning of a move higher, a little recovery, and we do start moving higher. It's possible. But until we break like that trend line, bonds are still very much in question. But if you were in a 60-40 portfolio, you definitely could have saved your 40% loss in bonds on this monthly candlestick chart. Okay, gold. I think we did gold a while ago, but it's pretty important right now. So now we're looking at a weekly chart of gold, okay? And GLD is the ticker symbol for the ETF that I used, and it established back here at the end of 2020 or end of 2004. So gold moves higher into 2011 and puts in a peak, right? Does this really good cup and handle pattern. Okay, cup and handle is a great. It's a really one of the most obvious patterns that if you get a confirmed break to the upside, it means the market's going to keep going in that direction. So it's really almost a cup and handle, right, on a big time frame, but with another cup and handle as part of it. So it's really forming this base that's getting ready to explode to the upside. And you got a high, and it looks like on this weekly chart, it finally broke out of that long-term resistance level at 185. Okay. So if you're looking at it weekly on a long-term chart like that, this is a breakout in gold. Okay. If we zoom in a little bit, it's the same weekly chart, but we're just looking at, going back to 2020. You can really see it here, right? You got a high, a high, but off of this high, you had a pretty good move down. We got this kind of cup pattern, but then it retested that high and broke to new lows. Okay, so basically this whole thing is out when you break down to new lows. Then it rallies, hits that high again, rolls over again, but it does not. It makes a higher low this time. Okay, so now it gets on your radar because now it's a higher low. Broke through this last high. So if you're watching, it broke above that last high. And then when it came down, it got support at what used to be resistance, right? This was resistance all these times, and it got support here. And then this explosive breakout to the upside, okay? Definitely a breakout in gold. And the good thing about it is we got this breakout, right? And it's impulsive to the upside. It's consolidated here for a few weeks, and then this week broke out again. So if you were looking at it, you're going, okay, this is a multi-decade breakout right there. If I buy gold up here and it gets below this low, I'm out. So this is your risk. Okay, that's your, whatever percent that is, that's your risk. But given that it came out of this multi-decade base and exploded to the upside, the odds of this moving higher are very, very good. So I'm kind of bullish on gold, if you can't tell. Okay, and I actually looked for it in the mutual fund window, and there are some gold funds in there, but none of them look like this chart. So in mutual funds, it's very tough because you don't really know exactly what's in there. But this is the gold ETF, and I have not been able to find a gold fund in the mutual fund window that matches this chart. So if I do, I will let you know. All right, C-fund chart. So, we look at this every week. It's the weekly candlestick chart of the C-fund. Only thing I wanted to point out, which is kind of what we recommend. I don't say recommend, I hate that word, but if you're watching your TSP account on a weekly basis, this is a 20-week moving average line and a 6-week moving average line, okay? So this one is 20 weeks, and the one that's really tight to the candles is 6 weeks. So the reason I did that is because at the 6-week moving average line, since it crossed above it in November last year, it has never closed the week below. It's come down to find support there, but it's never closed the week below that 6-week moving average line. Okay, so if and when it does get below that 6-week moving average line, right, something is going on, okay? And since we always use the 20-week moving average line, if you waited to find support at that 20-week, right now, it's a little more than 6% to the downside. So you'd have to absorb a 6% loss from where the market closed on Thursday down to its 20-week moving average line. Okay, that's if you're looking at it on a weekly basis. If you look at it on a daily, we use the 20-day moving average line. So this is a daily chart now. And since November, the breakout in November, it's got support every time it's come down to that 20-day moving average line. So if you're looking at it on a daily basis, you only have to take a 1.4% decline before you're making a decision, right? Because if it breaks through that line, it means something's changing in the trend. And that's when you would make a reallocation decision potentially. But if you're looking at it on a daily chart, you're only risking, 1.4% before you have to make a decision at this point. And since we know the market is really overbought at this point, and we're looking for it to turn over and give us some kind of correction, you might want to look at it more on a daily basis than a weekly basis going forward until we start into this next corrective phase. Okay, a little rant. So, anybody...
Is it a little rant or a big rant?
Little.
Okay.
Anybody who was watching this is Reddit, okay? Reddit IPO'd last week. It was about $51 where it IPO'd, opened right there. So I did this on a percentage scale, okay? So the zero line is where it opened, where it started. It went up as high as 44%. Okay, so somebody bought it up here. This was like $78 or something, because it was like 51, I think, was the open price.
Hopefully they sold it really quickly.
Somebody bought it up there. Okay. This is a 30-minute chart. Okay, so each one of these candles is 30 minutes of price action. It was last Thursday. It was the open right here. So it went from where it opened to almost a 50% move to the upside to close at a 5% loss this Thursday. So 1 week, it went up to 50% gains and down to a 5% loss. Why did that happen? So I did this as a rant, but also as a nod to Conan, because he always says that he doesn't like using technical analysis on individual stocks.
Right.
Okay? And so here's what happened. Reddit shares slump after CEO Steve Huffman sells 500,000 shares. He's the CEO of the company.
Yeah.
He sold 500,000 shares.
Cashing out.
He cashed out, and the stock tanked.
Yeah.
Right? If you go to the video of this on CNBC, they're talking about it was in the prospectus that got posted 3 weeks before the IPO. So if you thought you were going to get in on the IPO and you were able to get the prospectus and you actually read it,
right?
It says in there that the CEO was going to be...
That was part of the plan.
Yeah, it was planned.
Yeah.
So if you read the fine print,
yeah, it
was in there. And how you would... I have to assume that the people that bought it at the IPO and the knucklehead that bought it at $75 or whatever it was at the top did not read the fine print.
Right.
And so basically the rant... This is the best pump and dump scheme I've seen in a minute. I mean, it's not even a meme stock. It's not supposed to be. It's supposed to be a real legit IPO, right? I mean, who knows? It could turn back around, and it's an interesting, video on CNBC. But
yeah, well, it's always interesting to me to watch a company go public. We were talking about this the other day, where less and less companies actually go public now, because there's not always an upside to it, right? There's a whole lot of things you got to do to go public.
A lot of regulations.
And a lot of it has to do with just ego, right? Mm-hmm. So somewhere in the mix, the people that are in control of a certain company, it's kind of a badge of honor to go public, right? That's always kind of been the case, right? But financially, it's not always like the best thing to do, right?
It can be great if you're going to cash out.
Well, that's where I was going.
Yeah, sorry.
That's where I was going. So if you stay private, there is no possibility of cashing out like that. You can't do it. Like, you would just bankrupt the company, right? But if I don't know anything about Steve Huffman, or I know a lot about Reddit because I use it, but I'm like, I don't know anything about their CEO. But let's say he's been there a while. I don't know what the deal is, but like this was his way of like, okay, I've worked hard for this money. I want to get this money. I need this money. Personal circumstances. We talk about it all the time. Even rich people have personal circumstances. So anyway, I am not a fan of using technical analysis on an individual company, mostly because once you drill down that far, you are taking into account a lot of fundamentals that are going on. If you ignore them, it could be at your peril.
Yep.
Like this,
yeah,
right? If it not only was it written in the prospectus, but like if you're following the company, you should know what's going to happen after the IPO, right? You should, and so technical analysis is going to be a little too late on it, right? Because it's not because the price is the only thing that matters.
Yep,
I do agree with that, but in a situation like this, like price is going to go all over the place depending on the fundamentals.
Now you could have, if you didn't know anything about any of this, and now this is a 15-minute chart, but still, you got
30 minute. Was it 15 or 30?
30, 30-minute chart. So you still, if you were really watching it, you can take a dip on the IPO. That's fine.
You could have made some money on this.
Well, yeah, but you could have made some money. So you
it's gambling.
Say you come in at the IPO. You expect a little bit of a dip. That's fine. You get a double bottom here, and once you get a breakout above the original IPO price, up it goes. Right? Okay, you get a pullback, no problem. You got consolidation, no problem. It's either going to go this way or it's going to go that way. Right? You got a really good channel right there. And once it broke to the downside below that channel, that was it.
Yeah, I would have always, and I do this occasionally, and I do consider it gambling. But if I looked at that, I would look at it like a swing trade.
Yes,
I would say to myself,
great swing trade.
If I can get 10% out of this, or 15%, whatever your line is, right? Whatever you're trying to get, if it hits that mark, I'm out.
Yep.
I don't care where it goes from there, right? If it doesn't hit there, okay, I lost that swing trade. But if it does hit there, I'm going to put the chart back up. So anywhere in there, wherever my line in the sand was, let's say, what is that?
You buy it at the IPO.
What was not the top, but the that where it consolidated, where I can't see those numbers. So
32%.
Yeah. So let's just say you were shooting for the moon, and you said, I'm going to make 20% off this trade, right? So you throw $1,000 in there, and you say, I want to make 20% off this trade.
20% is right there.
Right. So let's just say, because that's a reasonable number if you're doing a swing trade in these circumstances, not in all circumstances, but let's just say you're shooting for the moon. I'm going to get 20% on this move. Right there is where you sold it. The rest of that stuff you could care less.
Yep.
And so that would have been a great swing trade, right? And that's a great example of how you can use swing trading in a short-term window. Yep. Because the way swing trading works, at least in the fundamental level, is you already have your lines and the sand drawn. You already have an entry and an exit. Yep. It's already planned, and you ignore everything else. And in this case, IPOs are kind of good for that, right? Yep. If you say to yourself,
volatile. I'm
going to do, because you need that volatility to kind of make that swing happen. And so if you say to yourself, all right, I want 15% off this trade, and I got $1,000 or $10,000, $5,000, whatever it is you got, and I wouldn't put your whole portfolio in there.
No.
Right? It's called speculation for a reason, right? You're speculating. That's a better word than gambling, but it's pretty darn close. So anyway, this is a great example of a swing trade that you could do. And, if you shot for the moon and said, all right, I want to get 20%, 30% is probably a little unreasonable. That's not always going to happen. Yeah. But I think, anywhere from 10 to 20%, I call it shooting for the moon if you're getting 20%. Because again, if you do that, 5 times in a row, you just doubled your money.
100%.
Right, you just doubled your money. So a lot of people, not a lot of people, people that I follow in some of this stuff, that's what they'll do, right? Yeah. So they will search around for volatile stocks to be able to do, a 20% return 5 times in a row. You do that with $1,000, you just made $2,000, yep. Right? You made $1,000, yep. Right? So you got $2,000, and so that's not a bad day's work.
No.
Right? No. There are people that do that.
That's a day job.
Yeah, and you have to be obsessed with looking at all that stuff. And so, anyway,
I just wanted to
so you got me ranting now.
Yeah. So anyway, Yeah. So if you like the stuff, definitely sign up for the newsletter. We have a lot of much more in-depth day-to-day kind of stuff for subscribers to the site. So
yeah, absolutely. Every week our subscribers get analysis that you're not going to find anywhere else. Nobody else is giving you analysis on the market as it impacts your TSP.
yeah.
It's just rare. There's a couple people that do it, but not to the extent that we're doing it. And we do it because we wish we had that analysis when we were in the government. All right, guys, if you like what you see, share it with your friends. If you don't like it, share it anyway. If you have any questions or comments, please put it in the comment section wherever you find the video. If there's not one, shoot us an email.
Yep.
Support@growmytsp. The support team will get it over to us. And there you go.
There we go. Springtime next
All
week.
right. Let's go get a motorcycle.
Yeah, all right.
That's where we're headed.